Hey everyone, welcome back to the Week in Charts, where I run through the most important charts and themes in markets and investing. Another huge show for you this week, a lot of topics to talk about. Let's dig in and start with the Treasury bill market and potential problems there. So we have this crazy relationship that's going on now, really something we haven't seen in history, which is the spread between the 3-month Treasury bill and the 1-month Treasury bill has widened to 1.72%, just an enormous spread between these two yields. You have the 3-month at 5.12% and the 1-month at 3.4%. That's highly unusual. You usually see these two very correlated, one moving with the other. Kind of makes sense. They should both move together, but both really dictated by Fed policy. Really, wherever that Fed funds rate is, these two yields are pretty close to that. The 1-month especially. The 3-month is looking a little bit ahead in terms of what the Fed's going to do in the next few months, but usually they're both very close to where that Fed funds rate is. And so what we've seen the past few weeks, and really the last week especially, is this 1-month Treasury yield collapse. So we're down to 3.4% here. And the question is, what's going on? Why are we seeing this huge divergence? And if you do a search and look around, there's a lot of different theories that are going on out there. I'm not sure which one has the most credibility, but one that seems to be gaining the most traction is this idea that there's a fear of default, and that's driving people to rush in and buy 1-month Treasury bills because they'll get their money back sooner than that 3-month bill. I'm not sure that makes a ton of sense. But I don't think the government's going to default 3 months from now or 1 month from now on these securities. So that doesn't make much sense to me, but that seems to be what's out there. I think another factor could be just simply investors who are coming out of banks. So we talked about the money flowing out of regional banks and into money market mutual funds and into treasuries directly has gone up significantly over the last month. And perhaps we're seeing the effects of that with just so much demand for the shortest term treasury security that you can find, which is that 1-month treasury bill. So perhaps that's part of it as well. But really, my question would be, well, why hasn't the Fed done something about it so far? Maybe they're trying, or maybe that's coming in the next few days. But why hasn't the Fed gone out there and sold 1-month Treasury bills to try to bring that yield up and normalize it? Again, maybe that's coming, but that would be the question. And maybe the Fed will address it when they meet in early May. But regardless, we're seeing something very strange here. Could be a potential problem for the markets. Maybe it's indicating something, or maybe it's indicating nothing, and it's just a short-term issue that will soon be resolved. That remains to be seen. We're going to watch this pretty closely. I want to talk about the housing market shortage, and this is something that you're probably familiar with. You probably either yourself have seen it. Certainly, if you're looking for a new home, you've seen it, or you've heard it from friends, relatives. Everyone seems to be talking about the lack of available supply. So what's going on here? How do we get to this situation? Well, part of it is simply not enough homes were being built for a long time. So after that last housing bubble, the housing bubble of the 2000s, we had a collapse in housing starts, and it took a long time to really get housing starts up and moving back to their historical average. And we had a trend higher pretty much each and every year in terms of housing starts. But that really stopped in 2022 with that spike in mortgage rates. And we saw the opposite. We saw housing starts come down and come down very sharply. And now we're still seeing a pretty good year-over-year decline, 17%. That's the 11 straight months. This is something that you tend to see before recession. So it tends to be a pretty good leading economic indicator. But the cumulative result of too few houses being built is this gap, this deficit between households that have been formed and housing starts. And so this is a chart by Realtor.com showing you the deficit in terms of single family homes and total homes, which include multifamily homes. And if you look at it just on a single family home basis, there's a 6.5 million home deficit. And if we include multifamily, so that's the idea that people can go into multifamily houses or apartments. And so we shouldn't just be looking at single family homes. There's a over 2.2 million home deficit. So either way you look at it, There's a deficit in homes. We need more homes to be built. We need this trend that had been continuing for some time here that started in 2012. So we have new completions of homes increasing each and every year. And that continued in 2022 because there's a lag. It takes time, obviously, for homes to be built. We need this trend to come back. So when we get the 2023 data, this is probably going to show a decline, but we need more housing. Certainly, housing prices are too high, and this would help with that. But simply the household formation rate being above the housing available is not a good thing. So we want to see that change, and maybe that will start to change, judging by this latest survey here. Each and every month, the NAHB puts out this home builder confidence survey, and we saw an absolute collapse in 2022. We had seen a record high in terms of confidence, not too far before that, after the stimulus efforts, after mortgage rates hit all-time lows. You just had this housing boom, huge demand. Saw a collapse last year, but we're starting to see a slow recovery here, which is pretty interesting. A few months now, and you have builders talking about the reason why that is. And I think it's really a main driver is this lack of inventory. So 33% of current housing inventory is coming from new homes, new construction that's being built versus a historical average of 10%. So because so few people are putting their homes on the market, the existing home sale market has really collapsed. You have new homes being just a bigger part of that inventory picture. And I think that's causing home builders to be more optimistic, and perhaps they'll start building more homes. If we look at the stock prices here, that seems to be the expectation from investors. We have this home construction ETF at a 52-week high, moving in the opposite direction as housing starts. So if you look at these home builders, just tremendous gains over the past year. This probably would have been pretty surprising if we said a year ago that you would have seen these type of gains, but we have 30 to 50% gains in all of the major home builders, while the overall S&P 500 is down over 5% in the same period. So we'll see if the markets have gotten a little ahead of themselves, but the expectations, it seems to be, is that home builders are going to be benefiting from a secular trend of just simply more homes being built, because that's necessary from that deficit in terms of that increase in households. So we'll see. I think that obviously would be a good thing if that's the case. We need more housing. We need housing to be more affordable. So hopefully that ends up happening. So speaking of affordability, housing market continues to very slowly reprice. We now have year-over-year declines in terms of sale prices. This is existing homes down about 1% year-over-year. That's the largest decline since 2012. Redfin had similar data point first quarter, so a 3% year-over-year decline. Again, largest and first since 2012. And even though we're seeing prices come down, that hasn't helped activity very much. So if we look at existing home sales, so the actual sales number, we're still seeing year-over-year declines. This is a long time now of year-over-year declines, 22% year-over-year. So activity hasn't picked up as much as you would think, and perhaps that simply is because prices haven't come down enough yet. Now, where are these sales declining? Well, they're declining across all ranges. And interestingly, now the high-end market is seeing the biggest year-over-year declines, down 29%. And if we talk about that affordability picture, this is something I keep coming back to. It really comes down for most people in terms of what is that mortgage payment I need to buy that home. And if we look at the sales, if we look at the asking prices of homes for sale right now, and we apply that 6.39% current 30-year mortgage rate, what we find is still a very unaffordable payment for most people. It's at actually a record high in terms of looking back at history, $25.38 per month. And you can see where it was a year ago, much lower. 2 years ago, significantly lower. 3 years ago, you're well under $1,500 a month. So just a huge increase, short period of time. And as we said time and time again, simply people's wages did not keep pace with this increase, and that's why you have this problem. That's why you have this affordability picture. So what's going to help this? One of two things: mortgage rates come down or people's incomes go up. Obviously, the quicker, or number three would be prices come down. The quickest of those would be prices resetting. but you need sellers to adjust their expectations. That's been a very slow process so far. And it seems like likely to continue unless, again, we see mortgage rates really collapse. You're going to need to see prices come down in order to have more buyers come in and afford those houses. So if we talk about the risk of recession, we know the housing market's already in a recession. It's been in a recession for some time, but the overall economy, the debate really continues. And each and every month, we have different indicators showing a rising risk of recession. Here's one that we continue to look at. That's the U.S. Leading Economic Index out of the Conference Board. And if we look at that year-over-year rate of change, we're now at pretty good levels where in the past we've been in a recession or just about to enter a recession pretty much every time in the past. If we look at the 2001 recession, 08, 09, and 2020, you're looking at we're right there. So we talked about in the last video, is this time different? And you never want to say that in the markets, and it's becoming harder and harder in terms of these recession indicators to say this time is different. And here's just one more. Philly Fed, so looking at manufacturing activity, a survey put out by the Philly Fed, and we're now at levels that in the past, pretty much every time we've been already in a recession when we were at these levels, the exception being 2001, where we were at these levels just before the recession began. So is manufacturing enough to push the overall U.S. economy into a recession? No, as we talked about, the service industry is much bigger in America. You can have a manufacturing downturn without a recession, but we're seeing data points outside of manufacturing as well. If we look at housing, we look at retail sales. So all of these indicators are building, making it harder and harder to make the case that we won't see some type of downturn this year. So let's talk about EV credits. I thought this was an interesting graphic from the Wall Street Journal where they showed the current EV credit, what you need to qualify for that. It's been changing every couple of months, and the most recent change that they made was a higher percentage had to be made in terms of the battery in North America. And so fewer cars qualify. Really, you only have American models now that qualify for this EV credit, and just 16 models. The last time it was 25 models. And you have to be under certain price points. Your household income has to be under a certain level, and you have to have a certain percentage made in America. Those are really the qualifications. And so if you're looking for an EV in any one of these brands down here, you're not going to qualify for this pretty substantial credit, $7,500 on the full credit, $3,750 on the partial. Now, in terms of what Tesla has done to qualify, to get its vehicles to qualify, well, they've really cut prices aggressively. And if we look at their recent earnings report, you can see this is probably filtering in terms of their revenue growth numbers, which revenue growth came in at 24%. Still pretty good compared to many companies, but for Tesla, that's a much slower rate of growth in terms of what investors have been accustomed to. And part of that, at least, has to be due to that change in pricing. And what's interesting is that we've seen really a divergence here between Tesla and other car makers. Looking at the used car market, Tesla prices continue to fall, and probably a reflection of those huge price cuts, while the overall used car market has now started to move back up. So we'll see if this divergence continues. But on a year-over-year basis, average used cars down about 5% in terms of pricing. Tesla models are down 25 to 30%. So this is, of course, going to hit margins unless you're selling, unless you have something else that's going to boost profit margins. If you're selling your vehicle at a lower price point and costs haven't come down, your margins are going to be hit. And that's what we saw with Tesla. 29% gross margins a year ago, 19% currently. And we saw that hit net income down 24% year over year. So what we're seeing with Tesla is not unique to just Tesla in terms of the slowdown. We talked about last quarter, across the board, we saw tech slowdown. We only have one big company yet that's reported, that being Netflix. And really not much of a change from last quarter, 3.7% year over year, a little bit better than last quarter, but still the second slowest quarter in Netflix history. We saw a hit to the operating margins. They blamed it on currency impacts, dollar appreciating, and we saw net income go down year over year. So I think this is going to be another trend here for the first quarter in terms of profits for the S&P 500 being down again year over year, and tech companies seeing a bigger hit than other companies. So if we look at Netflix subscriber growth, it's one of the huge and most impressive growth stories in history. But we're getting to the point here where it seems to be much more difficult for Netflix to add new subscribers, certainly on a percentage basis, but they added a little over 1 million subscribers in the first quarter, and we were seeing just much bigger growth for years and years. So are we at the point where there's saturation? Netflix is trying different things in terms of different subscriptions with ads, and they've talked about not allowing people to share the accounts. They haven't implemented that just yet. I think they're holding off on that, and when they do that, maybe there'll be a boost from that. Maybe there'll be a decline. It remains to be seen. But they're trying different things. But I think the big point here is you had just this tremendous growth for years and years, and now you have most of the people who want, at least within the U.S., want a Netflix subscription already have one. So they have to come up with new ways to innovate and to make profits. And we'll see if they can figure that out. So let's talk about an area that is not seeing a lack of enthusiasm. And the question really is it become irrational in terms of this exuberance for AI? And here, I'm not talking about the actual AI companies, but the chip companies that are going to supply this AI revolution. And really, NVIDIA is the leading player in that, 88% market share, just huge market share. And the cost of these chips are just absolutely unbelievable. Shocked me here. This one article saying on eBay they're selling for $40,000 a piece, and that for ChatGPT they're going to need 30,000 of these. So just huge numbers. You're talking about billions of dollars in potential revenue for NVIDIA or other players that supply this. And what we're seeing in terms of NVIDIA stock is, of course, just a rapid move higher, and its valuations rapid move higher as well. So the stock just last week was up over 90% on the year. We're seeing its price to sales ratio just surge higher, 26 times sales, price to earnings up to 160 times earnings. So of course the expectation is that there's going to be huge sales and huge earnings to come. So that if we look at forward earnings, which I don't like to do, and forward sales, which I don't like to do because you have to then guess what the sales and earnings are going to be. But the expectation is that these ratios are going to come down because you're going to see much bigger sales and earnings. But the question is, has it gone too far? Are expectations too high in terms of what NVIDIA is going to sell, what they're going to make? Microsoft is already talking about making their own chips. Are there going to be other entrants into the market that take share from NVIDIA? Probably. And what impact is that going to have on the stock? It remains to be seen. But historically, as we've talked about, when you start to get over 20 times sales, very few companies in history have been able to grow into that. NVIDIA itself being one of those, it was trading at these kind of high valuation levels back in 2000. And of course, had a epic mean reversion after that. There wasn't a lot of interest in tech or semiconductors for a long time after that. But all of that changed with the recent boom. We have this peak in price to sales in late 2021 that was actually above the 2000 peak, then the collapse last year, and now we've had this mean reversion kind of higher in terms of expectations for these chips, saying like it should be reflected in higher valuations, that it's justified. So I just did one comp here that I thought was interesting here, comparing NVIDIA to Meta, to Facebook. NVIDIA now has a market cap that's over $100 billion higher than Meta. And why that's interesting is that Meta's net income was actually at $23 billion versus $4 billion for NVIDIA. And if we look at the year-over-year declines in net income, we actually saw a bigger decline from NVIDIA than in Meta. So This to me indicates that the expectations are very, very high for NVIDIA. You could say that Meta is going to continue to see net income declines. Perhaps that'll be the case. But is it justified that a company that has almost 6 times the net income is actually trading at a lower market cap? That seems a bit of a stretch, but we'll see what happens here. Investors obviously betting that AI is going to be revolutionary and that NVIDIA is going to profit off of that trend. So, speaking of trends, here's one that's gone up and to the right. That's the demand for Crocs. You might have them yourself. If not, your kids probably have them. They're seeing just a huge increase in revenue, doubling over the last 2 years, tripling over the last 4 years. And the share price is really starting to reflect that. Had a downturn last year, but coming back 52-week high, more than double off of the lows from last year. A lot of demand from investors, I guess, expecting bigger things ahead for Crocs. Let's talk about big banks and earnings. So they've all reported. Banks are always first to report. So first quarter bank earnings, I think they were received pretty well by the market. We had a move higher in terms of net income for the biggest bank, JP Morgan, up 52% year over year. Wells and Bank of America, Citigroup, all up year over year. Then we had the investment banks, Morgan Stanley and Goldman Sachs, that have more of their revenue from investment banking and, let's say, advisory, wealth management. They were actually saw declines year over year, so a little bit of a difference there. But interesting, net interest income is what a lot of people look at for the banks. And with the exception of Goldman Sachs, we saw pretty good gains across the board in terms of their net interest income. So higher interest rates helping these banks increase in their net interest income so far. And so what we've been talking about, though, is that not all banks are equal here. We're seeing the bigger banks really benefit from the idea that they're too big to fail, and the smaller banks are having more difficulty. And this chart, I think, illustrates it, showing JP Morgan Chase up 6% year to date, and the regional bank ETF down 27%. So what we have here is pretty big spread. We haven't seen much of a bounce, interestingly, after the Silicon Valley Bank failures and Signature Bank failures. We haven't seen a really strong bounce higher for the regional bank sector, but we have seen the bigger banks like JP Morgan Chase come right back, and they seem to be doing pretty well. So we have this big differential. Still, the question remains, is there going to be more stress in the banking system, or is there going to be another regional bank that fails? That remains to be seen. But the market is saying that this gap, that this wide gap is justified for now, at least, because of the economics, where these bigger banks are able to do better because they haven't lost as deposits. They're making more in terms of their net interest income, and we're seeing this bifurcation. So in terms of stress, one thing that I like to monitor is the Fed's balance sheet. And when the Fed's balance sheet is declining, it really indicates that the Fed is okay in terms of the emergency. And when it's increasing, it's the Fed saying that there's a problem. And so after Silicon Valley Bank failed, you had this huge increase, $392 billion in just a 2-week period for the Fed's assets. And a big part of that was simply loans that were extended to banks. But over the last 4 weeks, we've seen this decline. So we're slowly trying to normalize that. Again, as I said last week, I think the Fed would like this to see this continue, but it remains to be seen if there's problems that we're not seeing, that there could be another big spike higher in terms of loans. Let's say if there was another bank to fail. So I think this is very much path dependent. The Fed wants to normalize it, just like they want to increase interest rates again at the May meeting, because they feel that inflation is still the bigger risk. But will they be allowed to do that? That remains to be seen. But as long as this is trending lower, it means that the emergency in terms of banks needing this extra liquidity is kind of subsided for now. So hopefully this continues to decline in terms of the Fed's balance sheet. So sentiment has been a big factor for the markets. over the past 6 months. We talked about since October, really the most bullish thing for the US equity market, in my view, back then was that everybody was simply extremely bearish. So, what we've seen is pretty significant rally in the markets. We've seen volatility subside. The VIX is now actually at its lowest level since November 2021. So very interesting to see volatility really collapse here. And just really a month after the Silicon Valley Bank failure, we have this extremely low volatility, probably not something anybody was anticipating. But in poll after poll, the public is very pessimistic, not really reflecting the optimism of the stock market. CNBC does this All American survey every year, and they said 69% of the public hold a negative view about the economy, both now and in the future. That was the highest percentage in the survey, and 2/3 of people in the survey said we're headed for a recession already in one. And that last sentence, not a surprise to me because I've been doing these polls on Twitter, and they've been reflecting something similar, where most people say if we're not already in a recession, we're going to be in one soon. But this other one here, pretty interesting to me as well, that just 24% said now is a good time to invest in stocks. That was the lowest reading in the survey's 17-year history. And the prior record was just last quarter at 26%. So it's fascinating to me that there's more pessimism today in terms of the stock market than there was in March 2009 or October 2002. These other periods where you have just extreme bear markets, where the markets were down over 50%, you would have thought that the investors would have been more pessimistic during those periods of time. So especially March 2009, after that crushing bear market, where you had the S&P 500 down well over 50%, and you had the fears of just a total collapse of the financial system, that actually more people back then said it was a good time to invest in stocks than today. And I think a lot of this, again, is coming back to that inflation picture, where people really do not like high inflation. They want to see it go away. And that chart that I always show about people's wages not keeping pace with those higher prices, I think that's reflecting a lot of this negative sentiment. So, but if you're a contrarian, you view this as a good thing. You think that if people are so pessimistic, when they get more optimistic, they'll be more likely to bid up shares. And so historically, there's been an inverse relationship between people's attitudes about the market and future stock market, especially at extreme. So maybe this is one indicator. I thought it was pretty interesting also that with the markets rallying back over the past few weeks, we still have more bears than bulls in this AAII sentiment poll. So we haven't seen the bulls take over. We saw it very briefly in February. We had that run up, but very quickly the bears took hold again after that Silicon Valley Bank situation. And since then, we've seen more bears than bulls pretty much every week. So a good sign. If you want the market to go higher, you'd rather see more bears than bulls, all else equal. We're certainly not at an extreme today, not anywhere near where we were last October at the lows, but good to see nevertheless that even with this rally, there's a lot of skepticism out there. I want to end with something positive, and this is not something you often hear as being positive, talking about taxes, but I'm happy to be done with my taxes. And if you filed in the past few weeks, you're probably happy as well. So I'm going to view this as something positive. And just some interesting statistics for 2022. 43% of U.S. income tax filers, so those are people making $50,000 or less, they contributed 10% of the total income, but paid negative 4.8% of federal income taxes. So I think it would be surprising to people to know that 43%, not only do they not pay any federal income taxes, they actually get money back because of things like the earned income tax credit. And you often hear things like people need to pay their fair share, the rich need to pay their fair share, and I would agree with that. Everybody needs to pay their fair share. But how about this statistic? 10% of taxpayers, so those are people making $200,000 or more, they earn 44% of the total income, but pay 80% of the federal taxes. So if you look at this system that we have, it's actually a very progressive system where people who earn more money are paying the lion's share of the taxes, and as a percentage of their income, the percentage that they pay into the overall taxes is much higher. So looking, and that's true for every bracket here. So a million and above, they make up X percent of the income, let's say a little bit over 15% of the income, but they pay almost 40% of the taxes. So the question would be, if people are saying someone's to pay their fair share, well, how much? What is enough? We already have a system where 10% of the taxpayers are paying 80% of the federal taxes. And if we look at the average income tax rate, so these are the effective rates for each bracket, you can see it goes up with every bracket. So if you're making 50 to 100,000, you're paying on average 3.6% federal tax rate. That's after all the deductions and credits and everything else. If you're making 200 to 500,000, you're paying 13%. If you're making over $1 million, it's 25%. So very progressive system. Higher the income, higher the taxes on average. And this is something interesting. If you're looking at the federal government revenue, so where does it come from? Money doesn't grow on trees. Most of it's coming from taxes. And the biggest source of that taxes is actually individual income taxes, 54% of the pie. So 54% of revenues that are coming in are coming from individual income taxes. After that, you have social insurance taxes, so Social Security, Medicare, that's deducted. Then you have corporate income tax, just 8%, other revenue here, and estate and gift taxes, very, very small. It's an issue that people often fight about, and they've raised the limit on the estate tax higher and higher over time, but still a very, very small percentage of the revenue coming from that. Now, finally, I'll give you my thoughts on how to create a 1-minute tax return. This will never happen. It's way too simple, and there's way too many people who are benefiting, have a vested interest on making the tax code more and more complicated every time they pass a new tax bill. But if I had a magic wand and I could say, what would I do with the tax system? I would make it all on one page. It would be very simple. What's your income? Apply a flat tax to that. No deductions, no exemptions, none of the other crazy calculations, no alternative minimum tax, none of this different stuff, just a flat tax. This is what you owe, or this is the refund amount because you've withheld more or paid more and estimated in the end. And then you go on and be productive and enjoy your life and do other things rather than figuring out and spending all this time on your taxes. So hopefully one day we can come closer to this system. I don't think we'll ever get there, but closer, eliminating all of the complexities. And the tax code should be something that we all agree on. So with that, I'll end it there. Have a great weekend, everyone. Thanks for joining me. If you like the content, as always, subscribe to the channel, and I'll see you next time. Thanks.